Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
There's lots of reasons and a lot of talk today about real estate. Well, comes down to three main reasons why people invest in real estate. Which reason is yours? Join us today. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about three reasons to invest in real estate. How you doing today, AAA?
I'm doing well. I'm in sunny Florida today. I mean, there's only one reason in the world I can think of why I want to be in Florida in the summertime, and that's my granddaughter and her birthday being the 27th of July. So that's why we're here. We're celebrating our granddaughter's birthday and talking to the people in our radio audience at the same time. So pretty excited about both of those things.
Yeah, that's pretty nice. In the mobile office, right? We weren't able to record last week because we didn't have good reception in the mobile office, but I think we're good to go today. Got an exciting show.
Three reasons to invest in real estate. There's a lot of people talk about real estate all the time, right? And people are always thinking how they missed out on real estate or this or that or the other thing, right? And they missed out on good interest rates. They missed out on a good deal on a house or whatever the case may be. But we're talking about real estate for investing purposes. We're not talking about living in your home, right? Everybody needs a home. And it really doesn't matter what the home value is. I mean, I can think of our home, Daniel, when you were a little boy. I bought our home in 1987, and the values went up a little bit, but then they came down. They came crashing down, and they were down low for a decade plus before they probably before it was worth more than what I paid for the house. But you know what? I didn't care. Because I needed a place to live and I needed a place for my family to live. I didn't care what the value of the house was. All I cared about was what I was paying for a mortgage at the time. And then as time
if you're going to live in a house for 30 plus years, you almost don't want it to go up. Because unless you're pulling cash out of it, which a lot of people are doing right now to support their lifestyles, which can get dangerous. Yes. But you almost don't. I was talking to one of our employees, one of our advisors here, and he was saying how he almost doesn't want it to go up because when it goes up, the insurance gets more expensive and the property taxes get more expensive. But it's the same house. It's not like because it went up in value, it changed his lifestyle. He's not pulling out of the house to increase his lifestyle, right?
Right.
The house didn't get any better,
right?
But the property taxes went up and the insurance went up.
Right. That's a very good point. And the big thing is, right, people always want to pay off their house when they retire, they don't have a payment, right? But I say, it doesn't matter because you're still going to be renting it from the town. With at least in the state of Connecticut, right, with property taxes. Not all states are that way. I mean, you usually have some kind of property tax, but some states are lesser than others. But in Connecticut, it's nothing to pay $500, $600, $700, $1,000, $1,500 a month in property taxes, depending where you live and how much your house is worth and that kind of thing. So we have Connecticut, we have this thing where you have like Interstate 95 going through Connecticut, it goes east and west. And Interstate 95 is a north and south road, but it goes east and west through Connecticut, right? And so if you live like below Interstate 95 or below, actually it's Route 1 is below 95. If you live on the other side of Route 1 toward the water, your property values are like double and triple the same house, the same property north of Route 1 because you're closer to the water. You don't even have to be at the water, right? There could still be a half a mile between you and the water and all kinds of things, right? But you're closer, so you're paying more. Anyway, that's for your own real estate, right? But we're talking about investing in real estate. And when it comes down to investing in real estate, there's three main reasons why people invest in real estate. And whether it's real estate investment trusts or whether it's actual properties or whatever the case may be, or mutual funds or whatever it is, you're trying to grow your assets. That's one of the reasons. Another reason is you're trying to have income, monthly check, something that's coming in. And whether you use that or you reinvest it, that's a whole nother thought process. But income is another reason why people invest in real estate, right? And the third reason is that people don't know what else to do with the money, so they just buy real estate. And it's as a place to park the money. And what's really interesting because real estate, my understanding is real estate has created more millionaires and multimillionaires in this country than any other one kind of business. So that's why it's talked about so much, because people recognize how valuable real estate can be, and they're not making any more real estate, right? and so that's where, when you're looking at it, it's there's reasons. And my question to the listening audience today is, which one are you? Which one do you lean toward? Which one is your purpose? Or if you're invested in real estate for investment purposes, which one are you working for? Because things are not always what they seem to be. And you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And we're going to help you, and we're going to educate you in some things that you don't know about today and in every rendition and show that we do, because that's what we're about, educating people to be able to make smart decisions so that they can retire and stay retired. So today we have a paper to go along with today's show. We're talking about 3 reasons to invest in real estate. And the paper we have is understanding price to earnings ratios. Understanding price to earnings. When you invest in real estate, there's money that you put in, but what are you going to get out of it? That's the big question. And when are you going to get it out, right? So this paper is a page and a half or so, whether it's real estate, whether it's stocks or bonds or whatever the case may be. This paper will help you understand some of the basics of, is it worth anything? What is it worth? What's the value of this investment? Whether it's real estate, it's stocks, whatever it may be. Price to earnings, understanding price to earnings ratios, yours for free for calling us at 800-725-7616, 800-725-7616 for your free copy. You're listening to Financial Strategies with Andrew and Daniel Agemy, 3 reasons to invest in real estate. Daniel, when people are investing, the 2 major, like we said, the third reason why is that people don't know what else to do with their money. We're going to get to that, right? But the first 2 are, one is growth of assets. The other is income or monthly check. And it deals with the people are speculators or investors, right?
Well, at any asset class, you need to know. You need to have a come to Jesus moment with yourself, with your advisor, with whoever is managing your money or your assets. Am I an investor or am I a speculator? Right? There was an article that came out about GameStop recently, and Roaring Kitty, right, had sent out a tweet that he was liking the stock again. And this ad said that all these retail investors were getting in with the stock. That they're not retail investors, they're speculators. If they're buying that particular stock, that's not an investment, that's a speculation. They're hoping that people are going to get into it, drive it up. So there's not a right or wrong if you're an investor or a speculator, but what you need to know is, which are you? Everyone doesn't have the constitution to be both. Right. AAA. We work with a lot of investors, and these people do not want to be speculators. Sometimes they're speculators when they come and meet us. How do we know they're not speculators? Well, because we've seen their assets come down 15% and they start going crazy, right? That's not a speculator. They don't have that constitution. So when we're helping people manage their money, we're helping manage 2 things. 1, the investments, and 2, the emotional investment or the emotional drain that has to do with watching their investments. Some people don't, some people do. But what people have to do with themselves is understand, are you an investor or are you a speculator? And then whichever you are, check your investments to see if that matches. The speculator is not going to be happy with the consistent 7% returns. Mm-hmm. But the investor is not going to be happy with 1 week they get 42% and the next week they're down 76%, right?
Right, exactly. And that's a great thing for a quick test, right? For people in our listening audience to say, okay, which one are you going to prefer? And everybody wants to make money. Everybody wants to make money with their money, right? Well, I should say everybody, right? Yeah, I mean, we're familiar with
people.
Yeah, we're coming across a lot of people, it seems, with a lot of money in the bank that they don't care about not making any money.
Kind of disgusting.
It is because their money in the bank is not safe, according to that was on one of our other shows, so that's not for today. But the point is that most people want to make money for their money, and the question is a risk worth of return. Now, the speculator is going to take high risk, and there's speculation. So you might go up 42% in a week, like you say, but it could also go down 75% in a week. I think that's where Bitcoin comes in, right? Bitcoin is up and Bitcoin is down. And it's kind of a speculation from on the short-term model. The long-term model we believe in, right? That it's not going to be speculation over the long term. But so when we're investing in Bitcoin, when we see it go up to 70,000 a coin, or it goes down to 55,000 a coin, we're okay with that, right? Because we're not, it's like what I said at the beginning, we're not selling it. We're waiting for down the road, right? And it's not a big portion of the assets.
AAA, that's a perfect example. We are, none of the people we're investing with Bitcoin are pretending like that's an investment that you can count on it going up, right?
Right.
There's a conversation that says this is speculation. If it goes to zero, here's the plan. We don't think it's going to go to zero, but if we're the dumbest people in the world and it goes to zero, it's not going to wreck anything. It's not going to change your retirement. But if we're right and it does what we think it could do, it could actually change that's a speculation that we and some of our clients are willing to take. But we're going in open eyes. That's a speculation, right?
And it's a very small piece of the portfolio, enough to give you a jolt up when it goes up. But if it comes down, like you say, if we're the dumbest people in the world and it goes to zero, well, it's not. You're not going to feel it because everything else in the portfolio is so well diversified. It's going to go well. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 reasons to invest in real estate, and we're talking about this. And whether you're invested in real estate, thinking about investing in real estate, or just want some education, today's show is for you. And we got a book that's going to be able to help you just in regard to. We want to educate you. And this book called "The Most Important Thing" by Howard Marks. We've given it away before, and we like the book because we think it will give you some very fundamental and advice in regard to your philosophy in investing. And this book will give you for free by calling us at 800-725-7616 for your free copy. This is for the first 5 first-time callers. Okay, if you call before, don't expect to get the book. But if you are a first-time caller, it's for you. If you're a client, it's for you. Then just let the operators know that you're a client. And 800-725-7616 for your free copy of The Most Important Thing. And we're going to be right back and talk more about the 3 reasons to invest in real estate. Stay tuned.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income to enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you, so you can enjoy your retirement with a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, one of our newest clients, she came to us because she had some real estate, and she is a very smart lady. She did her own calculation, and she said, when I bought this real estate, I didn't know what to do with the money. Real estate in Colorado was cheap, and she bought a place to rent out. Was paying some great money at the time, right? I think she was doing something like $22,200, $22,500 a year. Gross. It sounds nice. It sounds really good. And a lot of things in Colorado has changed since she bought it. And she did her own calculation and said, I could literally put this in a money market account at Fidelity and earn more without the headache on the value of the property, not on what she invested into the property, without the headaches, without the floods, without dealing with renters, without doing all this. Literally sell it, take the proceeds, put it into a money market fund, and earn more. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Today's topic is 3 reasons to invest in real estate. And whether you're a real estate investor or you're wannabe real estate investor or just want to get some education, today it's for you. And this will be beneficial just in regard to retirement investing in general. Even if you're not particularly invest in real estate. Well, Daniel, that illustration of that lady is, we see that happening often, right? We talk with a lot of people who are invested in real estate, and they're saying, hey, my real estate has grown I originally bought this for monthly income, and now the real estate has grown so much that my monthly income is not doing, the percentage of it is not anywhere near what it was. And I think I can do better with you guys doing something different. And so we're hearing that all the time. And we ended up the first section with talking about speculators and where they're trying to make a big bang on their buck. And when it comes to speculators, one of the reasons why people invest in real estate is for growth. And this client that you're referring to invested for growth, but there was also an income element to it. And all the numbers don't work anymore. Like you said, she did her own calculations. But when those people are investing for growth, that's the idea in real estate of when they're like flipping houses or investing. Maybe they buy some land that is going to be worth something in the future, but that's not a short-term deal. Where flipping tends to be more of a short-term deal. Like we have a client that has been wanting to get involved with real estate investing. Either way, whether it was for growth or for income, but primarily for growth. And he took a little bit of his money and found somebody a contractor. And from what I understand, they were on track last I talked to him to make some good money on a flip that was, I don't know, maybe 6 months, 9 months in time frame. But that's one of the ways for speculation, and real estate is going to grow. And
well, real estate has grown, right? It has grown.
Well, good.
We don't know if it's going to grow. So for example, this client, right? She didn't buy it for growth. She's a conservative investor. She didn't buy it for growth. It did grow. It grew a lot.
Right.
But the income wasn't making sense to her anymore. Mm-hmm. So the 22.4, the 22.3, right? 22,300, 22,200 she was collecting in rent. Mm-hmm. There was an HOA fee. So the HOA fee since she bought it has only gone up. So that's close to $6,000. And then property taxes have gone up, right? So close to $3,000. Insurance on the place has gone up. And actually there was a flood. So insurance was actually very expensive because there was issues. So not counting special assessment fees, not counting work needing to be done, refrigerators needing to be replaced, stoves being needed to work, these kinds of things, the net was like 12.5 or so like $1,000 a month.
Almost
right?
half. Yeah.
Which was like a 3.4% return on the value of the investment.
Which that's not worth anything. That's crazy.
It's not even close to the headache. When you talk about the amount of work, getting the tenants, taking care of this stuff, dealing with the HOA, doing all these kinds of things, it's not even close. And that's where she said, well, look in my Fidelity account, I'm getting 5% in a money market.
Right.
So she came to us and said, I like the idea of a money market, but it's not going to be 5% forever. I know that. Mm-hmm. And there's no upside on top of that. So she looked at the property, she saw it grew. And that's, you and I believe that you invest for income, mm-hmm. but you want some capital appreciation as well.
Mm-hmm. Right.
It's TR equals I plus G, right? Total mm-hmm. return is made up of income plus growth. Mm-hmm. And so she bought this place for the income mm-hmm. now went away, but it got a lot of growth. Mm-hmm. And so she decided to get out of the property. She hired us to help her invest the money in a way that she could get a much better income and have higher growth potential as well. Protect her money from inflation, right? Protect her money from this crazy economy we're in, but also collect an income. And so what we were able to do in that situation was flip the money into some of the types of investments we do that we think have a higher upside. And so far that's proven out. But the income went from that 3.4% to around 6%.
Double
without the headaches.
Wow.
Right? That's the so going from 12,500 ish to 19,000, right?
Okay. Nice.
But there's no special assessment fees anymore, and there's no working with tenants, and there's no floods you have to deal with, and there's no these kind of things.
No contractors you have to deal with, and all the different headaches that all the travel. I don't know. I think that was a little ways from where she lived, wasn't it? So that if she had to go there's a little bit of travel involved. There's none of that stuff associated with that, right? And so that's a very good point. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 reasons to invest in real estate. And we're talking about one reason is growth, one is income, and the other is because people don't know what else to do with the money, and it's by default. But we have a paper that we'd love to give you to be able to help you understand, is it going to be valuable for you to keep your real estate, or is it going to be invaluable for you to invest in real estate? This simple paper called Understanding Price to Earnings Ratios will help you get clarity so that you can have power in your decision making. We'd love to put this in your hand for free by calling us at 800-725-7616, 800-725-7616 for your free copy of Understanding Price to Earning Ratios. Call now for that. All right. That's for free, no obligation. You listen to Financial Strategies. 3 reasons to invest in real estate is today's topic. So this person, this client of ours, let's call her Nancy so we can put a name because we don't like to use people's real names for privacy's sake, right? But let's call her Nancy. And Nancy, originally I heard you say that she invested because she didn't know what else to do with money. And she thought, well, real estate is cheap, so let's buy some real estate at the time. And that turned out to be very good. She didn't think about growth as much, or income, but as time went on, she realized, okay, the income is good. I like that. But then the value that, like you said, Daniel, the TR equals I plus G, the total return on something comes from the income plus the growth. So her real estate, she bought it for whatever, let's say she bought it for $200,000 and it grew to $600,000, let's just say, right? And so there was that growth aspect to it. The I aspect, the income aspect, was the $12,000 a year that you're talking about by the time that she actually sold it, as far as net income. And that's what we're really concerned is net income, right?
Net. Yeah.
Yeah. So that wasn't a big amount of money compared to that, to that asset, if that's what it was worth. And I was just using some numbers from that standpoint. But her not knowing what else to do with the money proved beneficial to her. It was a kind of like by default, she made money. And that was a good thing. And sometimes you calculate that, sometimes you don't calculate that. But in the end, she calculated it and it's worked out well for her with where her money is now and what it's doing now, because she doubled her money. She's doubled her income, from what I heard you say.
Yeah, just about a double on the income. Now, one other thing that's in there is people will say, well, what about the taxes? And I have to pay real estate fees. So these numbers we're talking about are all net, right? So like this, like 19 of income that she's getting net is after she paid for the real estate agent to sell the property. It's after she's taking care of taxes. It's after she's used some money for some other things. So a lot of people are worried about, well, I have capital gains. Oh, well, I have this. Or, well, I have that. Well, again,
even after all that stuff,
are you an investor or are you a speculator? So she said, I'm an investor. I'm not a speculator. Now 3.4% doesn't make sense. Yes, I could hope that the real estate market continues to go up, but I'm not investing for hope. I didn't buy this for hope, right? When she purchased it, the rents made a lot more sense. Yeah. Also, when she purchased it, interest rates were a lot lower, right? Mm-hmm. So you have to see what's available at the time. So as investors, we always need to be looking at what's going on in the world, what's available to me, because what made sense last week, well, let's not say last week, what made sense 2 years ago, 3 years, 4 years ago, 10 years ago, 15 years ago, may not make sense today, right? Because things change. We change. Our risk tolerances change, right?
That's right.
Taxes change. Governments change, right? Colorado is also doing another thing where they're making it more difficult for landlords. Right?
Yeah,
New York's done this.
Yeah.
And it's caused huge problems in the state of New York. where the governments are taking over properties because the landlords couldn't make any money and they couldn't kick people out, so they just walked away from the properties.
Wow.
California is doing this, and Colorado is getting more like this, where it's making it more and more difficult to be a landlord. You have less and less rights as the owner. And so all these things have changed. Property taxes have gone up. Insurance has gone up tremendously in Colorado, right? These types of things have changed. So we need to always be evaluating. So before we go to break, those 3 reasons we buy real estate, right? We buy it for income because we want to get paid.
Right.
We want to get paid. We want to collect income,
That's
right?
Yeah.
For growth, that's what you were talking about, the clients flipping, which is getting more and more competitive. If you have a competitive advantage, you can probably do that, but it's harder and harder to find those deals because more and more people are doing it. So you have to have a competitive advantage. Or you're buying some place on a lake. You're buying some place in a beautiful place in a lake. You said earlier, AAA, you can't print more real estate. You can print more real estate. You can print more apartments, you can print more condos, you can print, but there's certain types of properties you can't print more on a mountain somewhere with a beautiful view, or next to a lake, on the beach, right? There's certain types of spots that you could probably be pretty certain it's going to go up over time, right?
Right.
But again, you have to be that speculator, not that investor in that situation. And then because you just don't know what to do else to do with the money.
Right. Good analysis, Daniel. And so you listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 reasons to invest in real estate. It's time for us to take a break. But before we go to break, we'd love to give you a book. It's called The Most Important Thing by Howard Marks, a book that will be able to help you be able to invest or develop investment strategies for how you can actually get paid rather than hope to get paid. And we'd love to put this in your hand to the next 5 first-time callers at 800-725-7616, 800-725-7616. Or if you're a client, call and ask for the book. The Most Important Thing, 800-725-7616. Call now.
Important financial questions. Are you feeling confident that you have enough money saved to enjoy a stress-free retirement?
Honestly, I'm not sure.
That's where Retirement Income Sources investment advisory arm comes in. We exist to help you invest your money smartly.
I'm struggling to accept my retirement without a steady paycheck. So can you help me invest into a profitable revenue plan?
Absolutely. We have top advisors nationwide who have a fiduciary obligation to you, helping you generate retirement income.
This is Financial Strategies with Andrew and Daniel Agemy.
In 1973, I remember how my sister and brother-in-law bought a house. And it's great being the youngest of 5 kids, right? Because I could get to see all what my elder sisters and brother did and say, oh, I like this or I don't like that. And I could make my choices accordingly. But in 1973, my sister and brother-in-law bought a house. And if I'm recalling properly, about $25,000 to $30,000, brand new house, that they bought. And at that time, people listening to this that don't know, a lot of people listening know that's what houses went for or did at that point, right? But the income, when I say to people, well, what was a good income at that point in time? Annual income. And people will shoot out all kinds of numbers when I do this in a crowd. It's interesting to hear what the responses are because they're usually a lot higher than what they were. But back then, a good income was somewhere, $10,000 to $12,000 a year was a good income to live on at that point in time. So if we use those numbers, if it's $10,000, then the house was $25,000. It was 2.5 years worth of income to be able to buy the house. I'm Andrew Agemy.
And I'm Daniel Agemy. And you're listening to Financial Strategies. Today, we're talking about 3 reasons to invest in real estate. And AAA, that's pretty remarkable. It's difficult. It's difficult to say when real estate is expensive or when it's cheap. And that's remarkable because I pulled some numbers here and it says that the traditional rule of thumb, which no longer stands, is about 2.6 years of income to buy a house. That was the old traditional rule.
Sure.
And your example was 2.5.
Right.
So these are medians, right? And so throughout the whole country. So it could obviously change based on the market you're in, or they got a good deal. They did
Right.
2.5 instead of 2.6.
Right. And yeah, and that's real interesting because today that's a great way to measure things, right? Because people talk about they're so expensive today, or how real estate has gone up. And real estate has gone up in dollars, right? But how about value?
Right.
Like you're always talking about, it's an exchange of values. Now, the dollar numbers have gone up, just like back then, a good income was $10,000 or $12,000 a year. And today, a good income is what, $60,000, $70,000, $80,000, $90,000, $100,000 a year, depending upon, right? So it's a huge difference. And it says, well, it's a lot more money. Well, but what's the purchasing power? The purchasing power is down from that standpoint. And
exactly. And that reminds me of the Warren Buffett quote, right? Price is what you pay and value is what you get. And there's another saying, I forget who said it. Everybody knows the price of everything, but the value of nothing, right? That's
right.
exactly what you're saying is we know how much houses cost, but what's the value?
Right.
What's the value of the house? Have houses gotten so much better today? Are you getting a lot more than that example that you talked about? Are houses so much better that they should be 4 or 5 times income instead of 2.5? They're probably not as valuable because there's less land. Like I bet that house has more land than most people are getting today. Right. I mean, I think there's an acre of land or something on that, which today a lot of places are just postage stamps or just a little bit more than the property. So it's and here in Denver, it's even worse. They're building everything is like a duplex. Like in Denver, most everything is they're beautiful, and you don't know it's a duplex. It doesn't look like the old duplex. It looks like this beautiful place, but it's divided down the middle, and each side is somewhere between $1 million and $1.6 million. Right?
Wow. Yeah.
So you get half the stamp, right? Half the property, but the house costs the same amount, basically, right? The two most expensive things are the roof and the foundation. So they got both of those, but you can sell it for a lot more if you do it that way.
Wow. Yeah, that's interesting. And when you're talking about this, I just want to interject real quick here that there's different kinds of markets, right? Like what you're saying, the price versus the value. And what puts the price and value on thing is the marketplace, what people are willing to buy something for. And so there's the real estate market, there's the stock market, there's the fixed income market, there's the used car market, all these different things. And what gives value is what somebody is willing to pay for it. But today, like what you're saying, what the houses are 6 years worth of income is what the houses are going for today compared to 2.5 50 years ago. Well, but is it really worth that? Well, that's what somebody's willing to pay for it, but is that really the value? Well, it is, because that's what somebody's willing to pay today. But what's it going to be worth in 5 years from now? And thought process is going to go up, but is it always? And the key is your money working as hard as it can be. I mean, I want my money to be in a sweatshop. I don't want it sitting on the beach sipping pina coladas. I want it in a sweatshop. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is 3 reasons to invest in real estate. That's one is for growth, the other is for income, and one is because you don't know what else to do with your money. So that people invest by default. We have a paper that goes along with today's show. We'd love to give you other ways to be able to invest, like our example of our client, Nancy, that decided that she wasn't making enough money in income in regard to her investments. So she decided to change to the universe of income generating strategies. And so we have this paper, Introduction to Universe of Income Generating Strategies, investing for the I, more importantly than the G, getting the G along for the ride. You can have that paper for free, Universe of Fixed Income Investments or Income Generating Investments, by calling us at 800-725-7616, 800-725-7616. You listen to Financial Strategies because people don't know what people don't know. Glad you joined us today, Daniel. As we're talking about these things, we're talking about people invest for speculation and the growth trend. That's where they're flipping houses, trying to get money from the value of the house going up. But there is a lot of risk to go along with that. Things can change, and it has changed. You have to have, you mentioned earlier, you have to have maybe some insight into being able to get those houses. We have a client that used to be in real estate, and he went into real estate so that he could flip houses. Well, he's now gone into teaching because he can't buy houses. He's not competitive. He's not able to buy the houses to flip anymore. So that was one thing he was not counting on, and now he's doing other things to be able to create income for himself. So that speculation, it was not of value to him anymore. But investing for income to get a monthly payment, that's worthwhile. And for people that don't know what to do with their money, there's other options. But if you don't know what you don't know, you can't invest in the other options.
Yeah. So some people may not have heard of this way of valuing real estate before. So let's dive into it a little bit more. We talked about the rule of thumb. The median houses in U.S. cities used to be 2.6, 2.5, 2.6 times your income. So you did a wonderful job of explaining that. I'm going to use today's numbers. So if that was today, you earn $100,000 a year, then a house should cost somewhere around $250,000. That sounds pretty reasonable, right?
Right.
I think a lot of people would be happy they had $100,000 income and they could buy a house for a nice house. Like your example was a brand new house for $250,000. Mm-hmm. In the 2000s, it had increased to somewhere around early 2000s, 3.9, 4% median throughout the country. Right. Mm-hmm. So I think a lot of people would be happy if they could buy a nice house for $400,000 today with $100,000 income.
Right.
They'd still be happy with that. And then our numbers are showing that in the housing bubble, 2005, 2006, it was somewhere around 5.1, 5.2 times gross income. Mm. And we show, AAA, we've talked about this a lot. From 2019 to 2022, housing basically went up somewhere around 43, 44%. And you and I have talked a lot about this. We don't have time to get fully into it today, but houses are not worth, nothing in the house went up, right? The value of the house, or the use, I should say, of the house, the utility of the house didn't go up 44%. What happened? The thing that you're measuring, it went down by 44%. The dollar went down by 44% because we created that much money. Government created that much money for the COVID crisis. So your assets, basically food, basically everything went up somewhere around 45%, right? Groceries, some went up more than that. Housing, stocks, right? So to keep the same purchasing power of your dollar, you needed it everything to go up by about 43%, which makes stuff really difficult to measure, right? Mm-hmm. Mm-hmm. But if we look at housing today, so I just said that in the great financial crisis, it was somewhere around 5.1 times annual earnings to 5.2, and today it's around 6. Now, some real estate markets is up to 10 times. So I think Colorado is somewhere around 8, or I should say Denver's around 8 to 10 times annual earnings, which is ridiculous. And so what the question we have to ask is, do you think when we look back at historical returns of real estate, if in the 70s it was somewhere around 2.5 times your earnings, do you think real estate can continue, that multiple of income can continue to go up the same way that it's gone up? So if we just go from the early 2000s, that's a 50% increase, right?
Right.
So that would mean in some of these higher markets where it's 10 times, that would mean it would need to go to 15 times annual earnings
Okay.
to keep the same type of real estate returns that you would have gotten since 2000, the early 2000s, right? Which
Yeah.
to me sounds very unrealistic. It
Yeah.
depends where rates go. It depends on a lot of things. But so that's a way to measure what you can expect future returns to be. Another thing you could do is if you're looking to buy real estate and you see something at 3 times annual, that's a good deal. You should probably pounce on that thing.
Right. Right. Good point. So what you're saying is, as these numbers increase and inflation increases and all that kind of thing, it just makes that income that people are receiving by owning the real estate even worth less. And it's not like you can raise your rent. You get an assessment, an HOA increase of $100 a month. You can't raise your renters rent by $100, maybe $50. So that means you got $50 coming out of your pocket. You can only do that so long. What kind of business does that? Right. And so that's what we're talking about. If you're thinking of your money in the form of business and in truly investing rather than just a hobby, and you could something that you can lose money on, then you really owe it to yourself to take a closer look at the price and earning ratios. What are you really making on your real estate? What is it really worth? And could you be doing better elsewhere? And let me just say, along with this, kind of like a side note to this, when we're talking about this, a lot of people in our listening audience have annuities. And if you have an annuity, you owe it to yourself to get a second opinion, because the Federal Reserve has issued a present to many people who own annuities and people are not accepting that present, to where you can get more bang for your buck. If you have somebody looking at that can analyze that to what's in your best interest to help you make more money with your money. I mean, who wants their money? I mean, there's a lot of people that don't care about how much money their money make. Unfortunately, we were running into it, seeing a lot of people like that these days. But I thought that most baby boomers, at least, wanted to make as much money as they can. And if you're one of those kind of baby boomers and you have an annuity, please make sure you contact us. Call us 800-725-7616 for an analysis of your annuities, or to get the free book that we're putting out here, The Most Important Thing by Howard Marks, which will be able to help you understand the principles of solid investing. 800-725-7616. We're going to take a break. We'll be right back after this.
Strategy with Andrew and Daniel Agemy.
I was on a call the other day, and some people may not know, but there's a lot of companies like BlackRock, American Homes for Rent, Innovation Homes, H Homes, that what their job is they buy homes, individual, single family, typical homes, and then they rent those out to people. And on this call, they were talking about how these companies are no longer making enough in rents to justify owning the properties. So part of the reason houses have gone up so much is these companies have come in with a lot of money, bid up the houses so they could get the rents, but they need to make about 6.5% on net asset value, or the value of the home, and they're not making that anymore. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. Today's topic is 3 reasons to invest in real estate. One being growth of assets, the other being income, monthly income, and one's because you don't know what to do. Now, these companies that you're talking about, Daniel, they know what to do, and they know how to invest. They know about price and earnings ratios and that kind of thing. And they need to make, what did you say, 6.5%?
Yeah, they want to make 6.5%. on or off net, not what they purchased the house for, right? But the net asset value or the current value of the property.
Okay. So, and they're not doing that. And so what's going to happen? What's going to happen for people?
So on the call,
real estate?
right? On the call, what they were talking about is there's two things you can do. One, you can raise rents to bring up
If people
the
can
value,
afford them. Okay.
right? Or two is you sell the property. So if you're making 4%, you either need to raise the rent to bring it up to that 6.5% target, or you need to sell the property. And I mean, these are sophisticated people. This is their job, so they can figure out other ways to make 6%. We know they could put it in a U.S. Treasury and earn like 5.25%, right? 5.25%. So they need to be making more than 5.25% because that's how much they could get sitting rolling over T-bills.
Right.
So what do? On the call, they were talking about how their customer is tapped out. They don't have any more money. They can't raise rents. So they're looking to sell these properties. They're looking at selling the properties and using the proceeds to either buy better properties or invest in other things, buy back stock, things like that. Because there's two ways you look at your return. You could look at the return on your investment. So if you bought the property for $200,000 and you're earning $20,000 a year
Of income?
of income, that's a 10% return, right?
Mm-hmm. Nice.
But if it's $400,000, right, you're at 5% return. So now you have to evaluate, is that a gross, that 5%, is that a gross or a net number?
Yep.
And can you do better than 5%?
Mm-hmm. Right. Right. And so then if these companies can't, they're going to sell properties. Right. And then that's going to affect those people who are invested in real estate, the values of their properties potentially. Right.
I absolutely think it will affect the values of people's properties. People don't understand how much properties these companies own, number one. And number two, how thin the market is right now. You bring one supply, you bring 5% supply on it doesn't, it's not like, oh, look, stuff came down 5% because 5% came on. It's not like that. It could drastically bring people's house, which is good for a family trying to buy a house.
Right.
But if you're a real estate investor, that is not a good thing for you.
Right. Because the value of your house, your $1 million, your house value, your rental property or whatever property that you own is worth, not your house that you live in, worth $1 million, and it comes down to $800,000. Well, that's a significant loss. That's a significant loss. And now what do you do with that money? Well, I love the story of Nancy that you told earlier, Daniel, and how she was able to sell her property at a good rate. She ended up investing the net assets, the net proceeds from that money at higher returns than what she was getting by owning the property. She lowered her risk because now she doesn't have special assessments. She doesn't have property taxes going up. She doesn't have problems with the tenants. She doesn't have any of these things, which is also headaches. She's lowered her risk and her headaches. She has more tax advantage because what she invested her money in, some of the stuff she invested her money in is going to be tax-free now as opposed to ordinary income. And then she's more diversified from what she is. And this is a beautiful situation to have put herself in as far as getting better. And that's why we're talking about today on Financial Strategies, 3 reasons to invest in real estate: for growth, for income, and because people don't know what people don't know. Today we have a paper for you that we'd love to be able to put in your hands called The Introduction to Universe of Income Generating Financial Strategies. This is what Nancy has changed her assets to be able to get this higher returns and lower risk and more tax advantage and better diversification of her assets. And you can too. And you can have this paper for free by calling us at 800-725-7616, 800-725-7616 for your free copy. Daniel, what do you have to say as we just have a few minutes left? What haven't we said that we need to say?
So I think we need to focus on, are you an investor or are you a speculator? Because some people would say, when we talked about the value of these houses coming down, they might say, well, I don't care. I'm still getting the rents. I don't care if it comes down. And Nancy did, because this is money. She saw it as value and money, and she could put it into something else with a better risk adjusted return, with better upside potential and better income, which she cared about. So people can look at that and they can say, if it's valued at 450, if it's valued at $1 million today, and it comes down to 8, that actually is 200 grand that I could have had.
Right.
Not to mention what the rentals are. So in her case, right, you said it was diversified. It was in some went tax-free investments, some went into different types of things. But I'll give you one example of an investment. It's called a preferred stock, right? And so it trades on an exchange like a stock, but it pays dividends like a bond. So it's kind of a hybrid. And this is, I'm not going to say the name of the company, but it's a well-known, big, strong bank.
Right.
And it has a coupon of 7.5%. Okay. Now, we bought it right for her, and it's already gone up about 6-7%. So you get the 7.5% return no matter what, right? Other than a default or some crazy thing like that. But it's paying you that on a quarterly basis. It's tax efficient, so it's taxed better. It's not taxed at your ordinary income. It's taxed lower than your ordinary income. It's 7.5% instead of the 3.4% she was getting. And it's already had appreciation of 5 or 6% because of how it was bought. So wow. The reasons you invest in real estate, the 3 reasons for income, well, this was better income. In her case, this isn't for everybody, but our whole point is not to beat up or say bad things about real estate or anything. It's to reevaluate. Things have changed, right? So it's better income. The growth, we think it's a better growth metric because of what we explained with the multiples that we're putting on housing right now. The multiples are crazy. So to expect to get the same type of returns people have got since 2000, since the early 2000s, that's kind of crazy to think you're going to get those same types of returns because of where the multiple of annual income would have to go for those returns to increase. So that's risk-adjusted return. And then she didn't know what to do when she bought the place, and it was a better value when she bought it. Now she heard about us and was open to new ideas and is in this plan. So look at those 3 reasons. What's the income? Can you do better on income? Growth. Is your growth metric still good? If you're flipping houses and you have a competitive advantage to buy those, you probably have a great growth metric. But I know a friend who does that, and he's having a harder and harder time buying these things because he was going to buy this great deal the other day, and somebody else came in and swooped in, paid more than what made sense for him to pay because he wouldn't have made money. Right. And he just had to let it go. He wasn't going to bid up higher because he wouldn't have made the money he needed to make to do the deal. Right. And then what do you know? If you think that the only thing you can do is earn 3.4% or 5% or 4% or whatever it is, right, on current value, net asset value of that property, well, now you've heard the show and you could do better. And you want some more examples of how you could do better? Here's some banks. Here's some preferreds. You might have heard of these companies. Goldman Sachs, right? And I'm not endorsing these preferreds. We don't own most of these, but I'm giving an example because we're looking for the best risk return metrics. But here's just some examples. Okay. Goldman Sachs, 7.5% preferred. That means they will pay you 7.5% as long as you're owning this preferred, right? Okay. All right. Citigroup, 7.2. JP Morgan Chase, 6.8. State Street, anybody heard of them? 6.7, right? Synchrony Financial, 8.25. And these are all taxed better than ordinary income. These are tax advantage things. So these are some examples of, because of where rates have gone, people can pick up these kind of yields. I wouldn't say build a portfolio only out of banks
No.
only out of these types of companies. But these are some examples of some companies people have definitely heard of.
Yeah.
And the types of yields. These are all double what Nancy was getting from the property, and they're taxed better.
Right.
And there's no headaches.
Don't try this at home, folks. There's a lot of things we're not telling you here because we don't have time for and because that's our expertise. But we're trying to give you a 30,000 foot view of what you can do and what things you should be looking at. You're listening to Financial Strategies, Daniel Agemy. Today's topic has been 3 reasons why people invest in real estate. We have a book, The Most Important Thing by Howard Marks, that we'd like to give to you before we leave you for this week. And I want to say, so you can call 800-725-7616. So the next 5 first-time callers or clients are welcome to that book. And if you have an annuity, please, you owe it to yourself to get a second opinion on that. The Federal Reserve has done some things that allow you to get the same, to exchange it for something of the same risk profile, but doubling your rates, as much as doubling your rates. And if you don't want double, well, you know what? Go ahead, get double, and then give it away to somebody that is starving, or somebody that's in sex trafficking, or something else, some nonprofit that is doing some good in the world. Because you know what? There's big name people that are making money on your money if you don't make it. So would you rather give it to some big name people, or would you rather give it to somebody that can actually use it? Up to you. God gives you all the money to be a steward of. We want to help you be a good steward and to know what you don't know, to be able to do better, make good and wise choices. 800-725-7616 for the book, The Most Important Thing. Or if you want us to give you a second opinion on your annuity, we'd be glad to do that. But whatever it is, don't try this at home, folks. There's too many ins and outs of this that we're not telling you about that can end up making you a speculator rather than an investor. So as we leave you today, I want to leave you with the words that Louis Pasteur said, that chance favors the prepared mind. Be prepared.